You've tuned into ET Now, and this is the Money Show on the Rise with India with me, Karunya Rao. Well, we have a lot lined up on the show today. Let's take a quick look at what all is in store. Firstly, pandemic fear grips bond yields. Are debt mutual funds safe to be invested in today? Well, that's something we will be discussing. How good a bet that is. We'll also make you meet Kotak EQ Contra MF's manager, Shibani Sarkar Kurian. We'll get to know her better. We'll get to know the fund better and what are the prospects and why should you invest if at all. Lastly, we'll also be getting you a tech experts as well as Nubia handsets have joined the 5G league. But is India ready for the 5G revolution? Should you consider buying a 5G phone? Is Samsung Note 10 Plus worth the buck? We will discuss all that and much more over the course of the Money Show today. But first, Anil Rego, founder and CEO of Right Horizons, joins us to talk about our first big topic that we will be discussing on the show. Mr. Rego, hi, good evening and welcome aboard. Pandemic fear definitely has gripped the bond yields. Let's start with understanding how good a time it is or how good a idea is it right now to invest in debt mutual funds. What is your perspective?
See, obviously you're investing in debt mutual funds to lower risk. You're looking at a relatively safer avenue, and yes, it is. However, debt mutual funds have a lot more depth and options, and one could use a whole range of funds to look at and choose from. And we've seen some bit of volatility in bond yields in the last couple of weeks. What is interesting to note is that you find that government GSEC yields have actually ended up coming down, whereas the yields of corporate bonds have gone up. What this actually means is there's a bit of a flight to safety, which means people are buying government bonds more and possibly selling corporate bonds to get there. And now the question is there any risk that you see to it? Should you be looking at bonds and also debt mutual funds? Yes, definitely there are avenues for you to look at. The schemes that you look at are possibly more on the shorter duration funds, because when you look at longer duration funds, you'll find that the risk or the volatility due to interest rate cycles can be more, which basically means that if interest rates end up going up, then you'll see that bond prices fall because a new investor can buy it at a much better yield. So it definitely makes sense to look at shorter tenure bonds. At this time, I would suggest you look at the longer duration bonds. GSECs are also an option, but I think I would still go for maybe shorter tenure and duration GSEC funds. You can also do liquid, ultra short term, and possibly even short term funds, and I think that's where you can put in your allocation in the debt mutual fund side.
But if you're saying that if people want to avoid risk and they want to avoid the volatility in the market, they can perhaps look at debt as a good option. But investors should also understand that even in these schemes, they also have an element of credit risk, right?
Yeah. So there are two risks actually in terms of debt mutual funds. One of them is credit risk. Credit risk could be either due to default or delay in servicing of the bond interest, by the issuer. So that is definitely there. It's important to look at bonds of good quality, and that's the second part of it. At a time like this, GSECs are the safest because they're coming from the government, or GSECs are basically government security bonds. Okay, so the second best would be looking at bonds with a AAA rated, corporate bonds which are AAA rated. So that's the best credit rating. And so if you look for schemes with a better credit rating, then you would sort of reduce the risk of default. Now let me say that one option you have is to go and do it yourself, but you'll find that the default risk may be much higher when you yourself go back and invest in the bond yourself, because you may not be able to diversify as much as, let's say, a debt mutual fund would diversify. So even if there is a an issue with one paper, typically you'll find the average exposure to any one debt instrument is say 2 to 4%. So you'll probably not lose your capital, but you may lose off a little bit of interest. Whereas, if you actually go and invest directly in bonds, you'll probably, you could lose capital as well, and it can be a much larger impact for you. Of course, you have the other option of going and investing in bank fixed deposits, etc. But for higher tax bracket investors, that may eat into a lot of your interest income that you get. So, debt mutual funds may still be a better way of going about it. But look at ones with lower credit risk, which means where the credit quality or the bonds, that underlying bonds are of good credit rating. And second is look at lower duration, because that's the other risk you have of interest rate risk, and lower duration debt instruments and debt mutual funds may help you address that risk also better.
But Mr. Reko, if for the benefit of our viewers, you can also tell us how one can tackle the kind of risks that they are, or what are the things that, or what are the mistakes they can avoid making while investing in this particular asset class?
Yeah, see, right now you will find that a lot of the schemes are showing some very good returns, right? You may find some schemes showing you a 10% return, and that is because most of the time, it's a higher duration fund that is around, and you have invested into, and you may find that interest rates have come down, and that is why you would have a capital appreciation. Now that is short term, and interest rates have definitely come down sharply, and you may find some of these schemes actually delivering very good returns. And the mistake most people do is they look at the past returns and then say, oh, this is a great one to invest in, and they get caught in a situation like now, when suddenly you find interest rates actually start moving up for the corporate bond schemes, etc., and you may find value erosion. So I'm saying it's important to understand the categories, understand also that high duration funds can deliver you better returns, but that is already delivered for somebody else. It may not be for you. The second mistake that people typically do is they again run after returns. Even in a lot of credit risk schemes ended up getting money. Schemes with lower credit rating also ended up had a lot of infusions, and you would find that you need to understand there is an underlying risk associated with it. And so when you invest in instruments which give you a higher return, you may actually end up seeing a little erosion in capital, or impacts a lower return if the credit cycle turns bad, if the defaults and the economic environment turns bad. So I think these two things you should be careful of, not going by past returns, both in credit risk funds as well as high duration funds.
When an event like ILNFS, DHFL happens, Reliance Capital, Altico, I mean, the best of funds, very good pedigreed funds have also bit the dust. How can one choose which fund is correct for them, or how can they sort of protect themselves from something like this happening, or to have exposure to companies like these?
Yeah, definitely. It's a bit difficult for a retail investor to actually look at and choose a particular fund within the debt schemes. I think the first would be actually to go back and look at ones which are funds on what is their credit rating, and all of this information is available on various sites. If you go drill down into a particular fund, you'll find that there's a lot of information on what are the underlying bonds they hold, what is the underlying credit risk there. So I think that's the first way to look at it. The second is, it's a more complex one, because you have recently found that even very good quality ones ended up going bad, and that's something that is very difficult to assess, because if you have invested in a AAA rated scheme and a AAA rated paper which is the best quality, goes into default, then it's very difficult to assess that. But how do we professionals look at it is, then we understand what are the investing processes, how these schemes have done in earlier periods when there were credit cycles. I think even getting back to spending time with fund houses, which we are able to assess and see, what are the methodologies that they follow, how, what are the credit rating that they have internally, because sometimes, they depend on external ratings. So it's important to have a good risk management team also within the organization. But these are slightly difficult to look at. Possibly one of the things that you can look at is there are risk ratios as well. So you can look at the standard deviation and other risk ratios, and look for funds which have a sort of a lower standard deviation, and then you will basically see, is the fund manager trying to take a higher risk, and but now you have a bit of a history behind you. You can, I think, from the various fund houses, you can see that some of them did pretty poorly, and they had a lot of impacts, whereas some did well. So you will also go back to that history and incorporate it and go with the funds which have done well.
All right, Mr. Rao, we have a couple of queries as well, so let's kickstart them as well, just to bring in what is it that our viewers would want to know. First up is an email from Anita. She says she's been investing 42,000 rupees via SIP in some funds. She wants to have 60 lakh rupees in 12 years for her child's graduation, and she wants 1 crore to be accumulated over the next 16 years for the child's future education, for post-graduation to be precise. And over the next 24 years, she wants 5 crore rupees for her retirement. So she has very set goals with very, very set timelines. She's invested in a host of funds. There's Mire Asset Large Cap Fund, 10,000 rupees goes there. Parag Parikh Long Term Equity Fund, another 10,000 invested there. Kotak Emerging Equity Scheme for 6,000. SBI Small Cap Fund, 3,000 there. HDFC Small Cap Fund, 3,000 there. And PF and PPF, a total of 10,000 rupees. So that makes up for 42,000 per month. So can you tell us how her investments look like right now, and will she be able to achieve those goals that she has set for herself, or should she relook and sort of rethink her investments right now?
Yes, unfortunately, the information given is not sufficient to actually give you a very precise answer. But just having a look at it from the overall data, it looks like she should be well able to achieve a couple of important needs, which is the child's graduation need, okay, and also the post-graduation education expenses. Now, obviously, there looks like there is going to be a shortfall on the retirement side, and this, if we had data around, let's say, what is the PF capital that she already has, and she also seems to invest in a PPF scheme. Also, past investments, what are the values of the past investments in the mutual fund side, would have helped us maybe give a more precise answer. But clearly, based on this data, there is a shortfall, and she would need to sort of spike up some of the SIPs out there. And in terms of funds that she's disclosed, I think she's chosen some pretty good funds, and I don't think there is too much of issue with the fund schemes. I think the bigger one is about what is the value that you can put into these schemes. All of the funds here are mainly equity oriented. The only thing that is non sort of equity, which is here, is PF and PPF. So one needs to look at what is the liquidity that she needs intermediate. So accordingly, you need to have certain liquid investment avenues, and if that is not there, then maybe some SIP into some of the debt mutual funds for the shorter term requirement. But otherwise, I think it's mainly a point of saying that how do you increase the monthly investments into the mutual funds so that you are able to achieve your retirement goal as well.
Okay, there you have it. I hope Anita takes note of all that you said. We have another live caller joining us, Mr. Rego. We have Indrapal. He's calling us from Ludhiana. Let's bring them on board. Hi, good evening, and tell us what's your query.
Good evening. Good evening. My query is regarding debt mutual funds. I would like to know how much risk-free exists ultra short-term or short-term fund to be invested in, and what does the credit rating of AAA negative? How safe is that to be counted?
Okay. Mr. Rego, over to you. What would be your advice?
Yeah, so both liquid and ultra short term, invest in bonds of very low duration. They also invest among the safest securities. So you'll not too many times find issues with some of the ultra short term schemes. Of course, there have been a few impacts that we have had in the past, but relatively you'll find that the impacts are a lot lesser when you come to ultra short term and liquid schemes. So I think definitely that is something that you can continue to do. The shorter term would depend a little bit on the interest rate cycle. So if we find that interest rates just spike up a little sharply, then you may find that the shorter term returns may sort of reduce, and it may not deliver a very healthy return. But keep in mind that let's say if interest rates go up, in the short run you may find that your bond value comes down, but it will also be compensated by higher yields, which means that, let's be given an example. Say if the yields are at 7% and it comes down or goes up to 7.5%. Okay, then you may find that the return that you get may sort of fall a little bit, but going forward you will end up getting 7.5% return. So if you are a slightly longer term investor, short term fund also okay if you're looking at something like a 2-year duration. So any capital volatility will sort of more or less get made up for by higher returns on a going forward basis. So that's also okay to do. In terms of a question of AAA is basically, there's a credit rating given by credit rating agencies, and AAA is the highest or the best and supposed to be the most secure, right? But that doesn't mean that some of the best companies do not face certain issues, because like in the case of ILFS, you found that they were not able to match, the duration of whatever their schemes that they or the projects that they invested into, but the maturities came up, and so many of the NBFCs and ones like ILFS had what you call as asset liability mismatches, and this is typical of financial services companies where you're borrowing and you're lending as well. So if there's a mismatch, then you may have a problem. So AAA rated is the best. It's maybe the best way of looking at it, but it doesn't mean that you cannot have any damage whatsoever, because a top grade company may end up falling for various reasons.
Neil, thank you so much. Indrapal, I'm sorry. Thank you so much for calling us, and I hope your query now has been adequately addressed by Mr. Rego. Moving on to our next email query. It's from Shankar Sen. They're based out of Andhra Pradesh. They've been investing 20,000 per month via SIP in equity mutual funds for more than a year now. They want to have 40 lakhs by 2030 for son's education, wants to accumulate 4 crores for retirement, which shall be in the next 23 years. He wants to know, can I expect 11 to 12% returns from the funds? And the funds are Parag Parikh Multi-Cap, Kotak Standard Multi-Cap, SBI Small Cap, Axis Growth Opportunities Fund, and Mirae Asset Mid-Cap Fund. He says he's already taken care of his debt portfolio by investing in PPF and companies EPF. ABSL Money Manager Fund, Franklin India Ultra Short Bond Fund as well is something that they would want to flag off. He has 2 questions now, Mr. Rego. Firstly, of course, he has told you his goals very clearly and wants to know whether he can expect 11-12% returns from the existing corpus that he has. He says, should I continue my SIP in Kotak Standard Multi-Cap? And which among Axis Focused 25 and SBI Focused Equity are better between the 2 of them? What would be your advice?
Yeah, so first of all, I think he's done a good job in terms of choosing his funds, and he's also sort of broken it up, against various segments, etc. Now, maybe one place that he can look at a little bit is the large cap side, because he has both Parek multi-cap as well as Kotak Standard multi-cap, so 2 multi-cap funds there. You may just want to look at a large cap fund, and a good large cap fund like, let's say, Mirae Asset and large cap and Axis blue chip as well. So both of these are things that he can look at. either to add or look at maybe dropping one of the multi-cap funds. Now, the other aspect he had was sort of on the debt side. Okay, he currently has Franklin Ultra Short Term, and Franklin Ultra Short Term has had a few impacts there. So if you want to sort of de-risk from there, you can maybe take that out and put off into an SBI Ultra Short Term. Now, his other query about should he look at Axis Focus 25 or SBI Focus Equity, which is better? Actually, both of the funds are very, very close, and performance-wise, both of them are pretty similar. But the fund that we like a little better is the SBI focused equity, because it does manage risk a little better. So if you look at the risk-adjusted return, of a SBI focused equity is a little better, and the risk measures also are better for it. So I think SBI focused equity is what I would gun for.
Okay, thank you so much for that. I hope Mr. Sen is taking note of all of that, all of those advices and recommendations. Another live caller is joining us on the phone line. Hari Prasad is with us from Bangalore. Good evening. What's your question?
Ma'am, I would like to know if I want to invest in a very short term, like 1 month to 6 months,
okay,
with a good liquidity, what are the best debt mutual funds that I can look in? I have looked at liquid funds as well as arbitrage funds as well as gold ETFs. Out of these three, which is the best option for me available for 1 month to 6 months of horizon?
Okay. Okay, that's a very tight timelines that he's working with. Mr. Ego, what would you like to say?
Yes, so it's a very tight timeline, 1 to 6 months. So from that period, definitely gold is a no. Okay, so let me start by excluding. So gold is a fund which you may see better return, but in the short run you may see some bit of volatility as well. Gold has done well, and so even though the outlook for gold in the medium term is good, from a 1 to 6 month period, definitely not a good option to look at. I think for his requirement, he can either look at liquid, and maybe an Aditya Birla Sun Life liquid fund can be one option that he can look at. He can also look at the ultra short term, and ICICI Pru Ultra Short Term is another fund that he can actually look at. I think I would sort of go between these two and park the money for the shorter term. Arbitrage is another option. He can look at arbitrage, especially if he's in the much higher tax bracket. But arbitrage, just in case there are certain market scenarios, you may find that where the interest rates can be also lower. So arbitrage is also an option there, and which he can also look at.
Okay, Hari Prasad, thank you so much for calling us, and I hope you will be able to now adequately take the right measures suited for your needs. Mr. Ego, thank you so much once again for chatting with us and taking time out to come on the show this evening. Okay, 2 new cases of coronavirus in India have sent the stock market tumbling down. Sensex has slipped more than 900 points lower from day's high to close at 38,140. Nifty also ended lower for 7th straight day. Last week, many posted their worst week since the global financial crisis. Jayesh is here with us to compare the pace of this fall to the 2008 crisis. Let's bring him on board. Jayesh.
What we have tried to do is mirror how last week's fall has been as compared to 2008, and there is quite a good insight that we can provide on this. If you have a look at the MSCI World Index in 2008, what happened in the month of Jan was it took 15 days to correct about 12.5%. That is the pace at which it actually fell. Now, if you see this in 2020, how this has in fact fallen, the pace of the fall has been on the higher side. Last 12 days we have seen 12% correction in the MSCI World Index. So fair to say that the pace at which the current correction has exceeded that of 2008. That's the kind of pain we are looking at in the market. Let's also have a look at how the Nifty behaved back then and how it is behaving currently. Of course, in 2008, we had 25 days in which Nifty corrected nearly 23 odd percent, or each day contributed about 1%. If you just go by the numbers over here, what has happened in 2020 that is different and it really is standing out is last 33 days we have corrected just about 9 to 10 odd percent. One of the reasons that I was looking at historical data, back in 2007, the Nifty had significantly outperformed the Dow Jones or the world indices as well. That is the reason we saw a greater fall in 2008. And this time around, what we actually have done is corrected less than the world. That is because going into this particular correction, there had not been much of outperformance. In fact, the Dow Jones had surged about 20 to 25% last year, and that's the reason we are seeing a more bearish reaction coming in from the developed markets instead of the emerging markets.
Thanks a lot, Jayesh, for that. Let's step into a short break here. We have plenty lined up when we come back. Stay tuned to The Money Show.